Hello, this is Sam Scharich with Calder's July off-market update. When we approach a business owner off-market and ask what they want for the company, we almost never get a real number. Usually we get one of two things, either make me an offer or a number well above anything they'd actually accept. And that's not the owner being difficult. Most of them weren't planning to sell. We showed up, and when someone gets asked to name a price on something they never put on the market, they anchor high because to them this is the opening move in a negotiation. So the gap is normal. Almost every off-market deal starts with one. What separates buyers who close from buyers who walk away isn't industry knowledge, and it isn't finding a cheaper business. It's understanding that a price gap is usually a structure problem, and structure is solvable. Before we get into that, here's a quick July update. In July, our buy-side team generated 305 introductions, held 144 calls and meetings, submitted 21 offers, and closed one deal. That brings us to 17 total buy-side closings on the year, with 21 deals currently under letter of intent. 144 calls and meetings was our strongest month of the year for calls and meetings. More owner conversations are happening right now than at any point in 2026. And in a lot of those conversations, the first number the seller says is nowhere near where the deal ends up. A price gap looks like a wall. It's actually usually a puzzle. Earnouts, seller notes, equity rollover, how the transaction gets treated for tax purposes, whether the real estate stays with the seller. Most buyers walk away on price, never working through any of those variables. Rather than talk about that in the abstract, I wanted to bring in someone who just lived it. Joining me today is Jake McDonald, one of our M&A advisors. Jake has been with Calder for over 6 years and has completed a lot of transactions in that time, so he's seen how deals actually get done. He recently worked through one where the buyer and the seller were a long way apart on price, and structure is what got it across the finish line, so let's get into it. Jake, give us the setup on this deal. What was the business? Who was the buyer? Where did the buyer and seller start on price?
Yes, Sam, thanks for the introduction. This particular deal that we just wrapped up was a individual buyer we were working with multiple decades of manufacturing experience. We had brought him an off-market transaction for a manufacturing business in the southeast of the U.S. It was a great fit for him, sold to attractive end markets, had a tenured management team in place, and had a lot of existing capacity within its facilities. So it was overall an attractive opportunity. We went through the process, held an introductory call with the sellers, requested financials, conducted an evaluation, the whole 9 yards. Ultimately, we got to the point where we were speaking with the seller and trying to get a better understanding of what their expectations were in terms of evaluation for a sale. They came back to us and told us they were looking for roughly $20 million for the business. Meanwhile, our seller had underwritten the deal at the low teens in terms of valuation. So there's a pretty large gap there. And then the question kind of turned to, okay, is this an opportunity that's going to be worth spending our time on, right? That's a substantial gap. And naturally the question is, do we walk away or do we double down and spend time solving that? So we sat on the deal for a month or two, kind of pondering that question, and ultimately came back to it, just given how good of a fit it was with our buyer. And as you'll learn, that ended up being the right decision for us.
I'm excited to hear more. So walk us through what actually closed the gap, what structure did you land on, and why did that work for both sides?
Yeah, so I think the big thing for us was rather than sit there and debate whose valuation was right, which is just a difficult conversation and really not one that has a winner on either side of it, we wanted to focus on why that gap was there to begin with. And then from there, what we needed to do to bridge that gap and what was going to be acceptable to both parties. So we had already identified why that gap existed. The business, if you looked at current performance, EBITDA, if you went back 2 or 3 years, was roughly double where it was at current day. And our seller was anchoring on that historical EBITDA. And obviously our buyer was anchoring on current day EBITDA as you should, and as Bank is going to underwrite. So that was really the why behind the gap. And from there we needed to determine how we were going to bridge that. So we were looking for items where there was a particularly high value of something for one of the parties, and it wasn't going to be a very big sacrifice if the other party had to give it up. So the first place we started there was purchase price. As we stated, the seller was looking for a much higher number than the buyer, and our buyer was willing to get up to that figure or close to it. as long as the structure aligned with what they needed and created a return profile that was in line with what they needed. So we went back to the drawing board, restructured the transaction away from 100% cash at close, and structured the deal. It's roughly 60% cash at close, 20% seller note, and 20% earnout. That profile actually modeled out very similar in terms of metrics, return metrics. Our buyer was fairly indifferent on getting that higher purchase price on paper, but it was a huge win for the seller to bump up closer to that $20 million number. Then on the other side of the table, our buyer was very focused on the transition period from the sellers. This was a business where the owners were very ingrained in the business, and it was going to be tough to transition them out with the day-to-day very quickly. So he was asking the sellers to grant him another 2 or 3 months on the transition period. And for the seller, even though on paper it might have seemed like a big ask because they were ready for retirement, but they had just spent decades operating the business and wanted to make sure it succeeded going forward. So the ask for 2 or 3 more months was really not a big gift for them. So again, something that was not a big gift for the seller, but a big pickup for our buyer. And there are a few other things in there, but those were really 2 of the main points that we had focused on to bridge that gap.
Gotcha. Let's dig into that just a little bit more. You said mostly cash at closing kind of structure to 60%, 20%, 20%. I'm curious on the earnout portion, 20%, was that based on EBITDA, cash flow staying consistent with current run rate, or was that based on growth?
Yeah, so it was actually getting back to the historical EBITDA. So the business had proven it could achieve it, and it had hit that mark for 4 or 5 years historically. And then recent challenges with tariffs and whatnot, all the common things that you hear about manufacturing businesses going through today, it had kind of stabilized at a lower level for the last 2 or 3 years. So the business had proven it could hit it, and we were basically saying, hey, look, we believe you, seller, that this business can do it, but let's put it in an earnout and we'll pay you when that actually happens.
So I have to ask, where does that deal stand today?
Yeah, so we wrapped up the transaction a couple months ago. Buyer has been successful in the first few months, and we're looking forward to seeing where he takes the business in the future.
So for any other buyer who's staring at a price gap right now and thinking about walking away, what would you tell them?
Yeah, I think the conversation of a price gap, right, naturally kind of gets defensive. Each side kind of stakes their ground and argues for what valuation, right, they want to achieve. That's not really a winning game. So as we mentioned, you need to focus on the why. Why is there a price gap to start with? And then look at what specific things you need or want in this transaction in order to get it done, and what are a few things that you are willing to give up or don't necessarily have to have. And then take that list of things you don't have to have and say, are there any of these factors that are not a big loss if I have to give them up, but are going to be a huge gain to the other side if I give it to them? And those are typically going to be the areas where you're going to bridge the gap. So if you're looking at a price gap right now, that's not the end. In fact, that's really the beginning of your deal and your negotiation. Dig into it, get creative, and the buyers who really dig in at that point are the ones who are going to be successful.
Fantastic. As Michael Scott, or was it Wayne Gretzky, once said, you miss 100% of the shots you don't take, so 100%. So thank you, Jake. Here's what I want to leave you with. What Jake just walked through is the part of a deal where most buyers never see from the outside. That deal didn't close or isn't about to close because someone found a cheaper business or gave up on it. It's going to close because the structure was built so that both sides could agree to it and viewed it as a win-win. And this is also why we push back when buyers tell us they need an advisor who specializes in a certain exact industry. Structure is structure, and earnout works the same in welding as it does in HVAC. What actually matters in the lower middle market is a process and reps, having seen enough of these to know which levers to move a deal and when to pull them. Every one of our 17 closings this year had a version of the moment Jake just described. So if you're in a search right now and there's a deal you set aside because the number didn't work, it might be worth another look. And if you're thinking about starting one, we'd be happy to talk.